Hello, everyone. This is Dr. Zaidi. In this video, I'll be discussing chart of accounts. So chart of accounts, major chart of accounts are as assets, liabilities, owner's equity, revenues, and expenses. Assets, liabilities, and owner's equity are balance sheet account, whereas revenues and expenses are income statement accounts. Balance sheet and income statements are financial statements, the type of financial statements that we are going to discuss in another video. But in this case, I'll be focusing on the chart of accounts. So what are assets account? Asset accounts record any resources your company owns that provide value to your company. They can be physical assets like land, equipment, machine, cash, or it could be an intangible thing like patent or trademark. Okay? Liabilities, on the other hand, are a record of all the debts your company owes. Liabilities accounts usually have payable, next to them. So, for example, accounts payable, bonds payable, notes payable, lease payable, invoices payable, wages payable, and the only exception to this is unearned revenue, which is a kind of liability, but it does not have a payable in front of it. Unearned revenue. It's usually a cash payments that your company has received before services are delivered, right? So unearned received in advance, unearned revenues received in advance without providing these services. Then we have equity accounts. They represent what's left of the business after you subtract all your company's liabilities from its assets. Okay, they basically measure how valuable the company is to its owners, or you can say shareholders. Okay. Then we have income statement accounts, revenues and expenses. Revenues accounts keep track of income that your business is generating, the income that your business brings from sale of goods or services you provide or rent. On the other hand, expense accounts are all of the money and resources you spend in the process of generating those revenues, right? It can be utilities expense, can be wages expense, can be rent expense, it can be depreciation expense, it can be wages expense, and income tax expense, and so on and so forth. So there are various expenses. So some of the examples or accounts within accounts we have are for assets, cash, accounts receivable, inventory, prepaid expenses. Prepaids are paid in advance, just like unearned received in advance. Prepaid is paid in advance. So mostly insurance, or when we buy an insurance, we pay ahead of the month or ahead of the year. So that is prepaid expenses. That's an asset for the company. Notes receivable, equipment, land, goodwill. So there are current accounts, current assets, there are long-term assets. That again, what current assets are, what long-term assets are, we're going to discuss in another video. But in this video, I'm just trying to mention what types of assets accounts we have, what types of liability accounts we have, owner's equity have, revenue and expenses. The examples of liabilities accounts are, as I said earlier, they mostly have payable in front of them. So accounts payable, wages payable, accrued liabilities, notes payable, deferred income tax, also unearned revenue. The examples of owner's equity include preferred stock, common stock, treasury stock, so on and so forth. The revenue examples are sales revenue, consulting revenue, rental revenue, or any source of revenue that the business is generating is the example of revenues. Some of the examples of expenses include salaries expense, depreciation expense, rent expense, interest expense, income tax expense, utilities expense. So these are some of the examples of expenses. Moving on to the balances, what accounts has what sort of balance? Assets usually have a debit balance. Liabilities and owner's equity has a credit balance. Revenues also have a credit balance and expenses have a debit balance. So if we go back to our first slide, you will see here that assets have a debit balance, liabilities credit, owner's equity credit, revenues credit, expenses debit. So what does that mean? That means that when assets increase, we debit, right? And since liabilities have a credit balance, when liabilities increase, we credit. When owner's equity increase, we credit because it has a credit balance. Revenues increase, we credit. When expenses increase, we debit. So if you are bringing more cash into the business, cash is increasing means assets are increasing because cash is a type of assets. Okay, if you're buying more building, then assets are increasing. Again, you have to debit that, right? If you're selling machine and equipment, your assets are decreasing. You credit that. Okay, if you are spending money, you are paying to employees, you're paying for services or utilities, payments, then your assets will decrease, cash will decrease. Next is liabilities. So when liabilities increase, we credit. When liabilities decrease, we debit. So if we are buying on credit, we are buying material on credit or anything we're buying on credit, our accounts payable is going to increase. If that increase means our liability is increasing, we have to pay it off sometimes. So we have to credit that account. When liabilities decrease, when we finally pay off whatever we have bought on credit, if we have accounts payable balance, we pay off, then our liabilities are going to decrease. Same thing is if we have any other payable, rent payable. If we didn't pay rent, then we have a payable that increases our liability, and when liabilities increase, we are going to credit. And when they decrease, when we pay off the rent, then the liabilities are going to decrease, and we're going to debit at that time. The owner's equity is the same thing, works just like liabilities. When they increase, we credit. When it decreases, we debit. So if we issue a common stock, we are going to have a more stock in the company, then we will have to credit it because our owner's equity is increasing. Revenues works the same way as liabilities and owner's equity. When revenues increase, we credit. When revenues decrease, we debit. So if we make sales by providing service or by selling merchandise or anything that we are doing, so if we generate revenues, then the revenues increase. And when the revenues increase, we are going to credit because they have a credit balance. Expenses, when expenses increase, we debit. This works same as assets. When assets increase, we debit. And when expenses decrease, we credit. So if we have a rent expense, if we have wages expense or utilities expense or any sort of expense, when it increases, we are going to debit it. When the expenses decrease, we have to credit it. That completes chart of account. Thank you for watching my video. Subscribe my channel for live updates.